Welcome, everyone. This is our 57th webinar since April. The M&A Club. The presenters' topics and attendance keep growing, and in the coming months, we will continue to represent the very best of our profession and other professions. Before introducing Maria, we're just proud to present the Chief Economist of Scotiabank this morning, and Maria Mangiocavallo, you can see on your screen, will do the introduction. Maria is the Vice President of Commercial Banking Quebec region and responsible for all commercial activities in Quebec. To round out the scope of her involvement, let me add two areas where Maria contributes to M&A outside her day job. She's on the advisory board and is a jurist for the Scotiabank Women's Initiative, and the M&A Club Advisory Board counts on Maria's contributions as an active member. It gives me great pleasure now to turn the talk over to Maria Mangiocavallo, who will introduce our guest speaker.
Thank you, Bram, and thank you, Lauren, and welcome everybody. So a little bit about Jean-François. Jean-François Perrault joined Scotiabank on December 31st, 2015 as the Senior Vice President and Chief Economist. Jean-François leads a team of economists to support Scotiabank's domestic and international business lines and clients from retail to capital markets, providing Scotiabank's senior executives, the business lines, and the customers with perspectives, insights, and forecasts on economic, financial market, and policy developments. Prior to joining Scotiabank, Jean-François held prominent roles with the federal government, the Bank of Canada, the International Monetary Fund, and the World Bank. Jean-François's educational background includes master's and bachelor's degrees in economics from the University of Ottawa. Jean-François, thank you for joining us today. It is a privilege to have you share your economic insights in today's webinar. While 2020 is now in the rearview mirror, it is a year that will not be soon forgotten as Canada experienced its worst recession since the Great Depression. But the extent of the recession was not as bad as was feared during the first wave of infections, thanks to Canada's impressive fiscal policy intervention. And as 2020 drew to a close, we started seeing some light at the end of the tunnel, especially as we surfed on the positive news of the campaigns for the COVID-19 vaccination, which started across Canada and other parts of the globe. And we got a little hopeful that this was possibly the beginning of the end of this tragic pandemic. However, from today's standpoint, looks like the reality is that it will take many more months before the vaccines reach enough of the Canadian population that make it so that our economy can begin to recover. And until then, it seems that Canada remains within the grips of the deadly second wave of the infection. And in response to the second wave, Canada is dealing with the pandemic with renewed regional shutdowns and with curfews, both of which continue to impact the economy. With many regions of the country facing restrictive measures to protect the public health this winter, what are the expectations around the Canadian and Quebec economy? Jean-François, is there light at the end of this tunnel?
Well, let's hope there is. So thanks very much, Maria, and thanks, Bram and Lauren, for the introduction. So let me first start off by sharing my screen, see if I can not screw this up. We're fine in the practice, but you never know. Okay, does that work? Maria, can you see that?
Yes, perfect.
Good. So, I mean, I think Maria, you framed it very, very well. We're coming off, obviously, an extremely bad year for a huge number of Canadians, a huge number of global citizens, for that matter. What we experienced here is no different than what most countries experience in one way or another. And, you know, as we were kind of going through the second part of last year, we were, you know, hopeful that 2021 would be a little bit different, or a lot different. And I guess, you know, we're starting off the year with, you know, dealing with a second or a third phase, depending on how you want to define it. Lockdowns, curfews, various things in various parts of the world and various provinces that suggest that maybe, you know, 2021 might not be all that different from 2020. So let me explain to you why we are reasonably confident that that is a wrong perspective. that, all the garbage that we're going through now and the fear that we have and the headlines and the reports every night that talks about COVID and vaccinations and progress or lack of progress, those are all very, very important in terms of kind of the short run outlook. But when you take a step back and you look at all the factors that are, typically that we would look to understand what's going to happen with the economy going forward, almost all those factors are pointing to extremely strong growth. So let me walk you through why we think that. Now, again, keep in mind, this is not to say that COVID is not important. It is, but there are other things going on that suggest that once we get past the next few weeks, next few months, we are in for a substantially different state of the world that we've been experiencing over the last almost a year now. So I'll start with this chart just to give you kind of a big picture perspective. To give you a sense of what I'm talking about. So if you look at the world GDP, so the chart on the right or the table on the right, GDP fell by about 4% last year for the world, which is unbelievably large. But you can see from our forecast, and our forecast is not all that different from other forecasts. For 2021, we're going to go 5.6, and 2022, 4.4. So more than making up the loss that we experienced last year. That's true in the US as well, minus 3.5 last year. Almost 6% this year, and 4.25% the year after that. Canada minus 5.5 last year, 5.3 this year, our expectation, and then 4.25 next year. Those are very, very strong rebounds in economic activity, and there's a range of reasons for that. One of the reasons is obviously that, as the economy starts to rebound kind of mechanically from just the reopening process, you obviously get stronger growth, right? If you shut down an industry and progress on vaccine controls allow you to open it up, for instance, travel, then you naturally get a boost from growth. But there's a lot more to that than a lot more to the recovery than just that. So let me start with one factor for which I don't have a chart, but is arguably the most important, if you will, and that's the U.S. outlook. So as I indicated, we've got a growth of 5.8% anticipated for the U.S. next year. It's extremely strong. That is the result, to a very large degree, from the election of President Biden. So, essentially, U.S. fiscal policy, which of course is being turbocharged by President Biden. So, President Biden's got basically a $2 trillion plan to what he calls the American Recovery Plan to help restore U.S. economic activity this year, or to turbocharge in some sense. We are, in our forecast, incorporating about 2/3 of that, and we anticipate, or we're putting what we call a multiplier on that, so the amount of economic kick that you get for every dollar that you spend at a relatively low level. And that means that the 5.8% that we have here is probably at the low end of what's likely to happen, right? So even with growth of almost 6%, we think there's upside to that. And there's potentially even more upside because over the last few days, going into the weekend, President Biden indicated that he wants to move forward with his infrastructure plan as well once the American Recovery Plan is done. And that's a $2 trillion plan spread out over a number of years. So all that to say that from a U.S. perspective, which of course matters tremendously for the world, matters even more to us because we're hardwired into the U.S., we are looking in 2021 and 2022 at probably the strongest years, back-to-back years that we will ever see in the U.S. And of course, as I said, there's probably lots of upside risk to that. So, a very, very good kind of external environment for Canada. And that's got a few implications that we've observed. So one of the implications is when we think about, other factors that suggest that growth is on the way in Canada, we can break it down a number of different ways. Here are four kind of charts explaining some of these things. The first on the top left is commodity prices. So for any of you that have been involved in the commodities market or commodities business over the last few months, you will have seen that the commodity market's been on fire. It almost doesn't matter which commodity you're looking at. You've seen extremely rapid increases in commodity prices that reflect partly, this anticipation of U.S. growth is going to be much stronger than we thought. Partly a reflection of the fact that China was growing more rapidly than we thought in the second part of last year. And those two factors really combine to create an environment where anticipated demand for commodity prices is rising very quickly, and that's leading to significant increase in prices. Now that's important for Canada because we are still a very large producer of commodities, right? When you can think of wealth shocks, so things that kind of fundamentally drive Canada's wealth, commodity prices are one of these things. So the higher they are, the wealthier, the better off Canada is. Commodity prices, as said, been rising much more rapidly than we thought. For sure, a positive impulse coming from that. No question, absolutely no question. The second, and that's the chart on the top right, are equity markets, which have benefited for the last number of months from, vaccine optimism. Prior to that, it was, the pre-election thinking that Biden would win and he would launch his fiscal stimulus plan. Since that time, obviously, he's won and he's launching his fiscal stimulus plan. So you've seen very strong equity market performance. And that obviously it continues today. And that matters for a couple of reasons. Firstly, it's an indication that markets are generally more comfortable with the risk outlook than they were a few months ago. Right? So the downside risks are much less important now than they were. Upside risks are significantly more important. Combined with a general increase in forecast for economic growth globally, but again, centered in the US, you've got a pretty positive environment for equity markets. And that matters, again, because Canadian households in particular, spend out of wealth. So when household wealth rises, which it has been quite significantly in Canada over the last 7 or 8 months, we consume a part of that. Fundamental driver of growth. Bottom left-hand side, and one of the reasons equity markets have been doing reasonably well, they're quite well, is we are without a question still in a very low interest rate environment. So the harm caused by the pandemic, the economic dislocations, and I've got a couple of charts later on to talk about that, the deflationary impulse that occurs when growth weakens have led central banks to basically cut rates to as low as it possibly go, certainly in Canada and the US, and commitments by those central banks to keep rates at those levels for a number of years. Canada, the Bank of Canada is talking about 2023, and the Fed 2024. And that obviously combined with what we perceive to be pretty strong growth momentum is kind of an unusual situation. Extremely accommodative monetary policy with very strong growth those aren't the kinds of things you usually see together. Now, of course, market rates, so yields further up the curve, so the 10-year space, for instance, have started to respond, and they are rising, I wouldn't call them aggressively, but they're rising kind of commensurately with the strength in the recovery that we anticipate, which is normal. But we don't think the rise in interest that we're seeing in the 10-year space, either in Canada or the US or the 5-year space, is indicative of a dramatic tightening. It's indicative of the fact that the economy is really set for quite strong growth. In the Canadian context, I think that matters is obviously the dollar, so the chart on the bottom right. And here, obviously, the Canadian dollar has been appreciated. And you've probably heard some folks say that the appreciation of the Canadian dollar is a headwind to growth, and that is often the case. We are a big trading country. The value of our currency matters for exports. It matters for imports as well. It matters for imports of capital goods in particular. But it does affect our competitiveness when our Canadian dollar appreciates. And it's appreciated, there's no question about it. And it's probably going to appreciate a little bit more. The question is, how damaging is that damaging to growth prospects? And we think it's not. We think what we're seeing in the Canadian dollar is basically a reflection of fundamentals. So if the currency is moving in line with fundamentals, it's not a headwind to growth. It's doing what it needs to do. Currencies, they react to fundamentals. And one way to think about it is to look at the chart on the bottom here, where what we've seen over the last number of months now, in line with the movement in equity markets, in line to some extent with the movement in commodity prices, has been, since the outlook has become much more certain, or we'll say much less uncertain, since folks have become more comfortable with the risk environment, not to say that there aren't any downside risks, but the risks have certainly shifted, you've seen a move out of the US dollar. We'd seen the opposite for the last number of years. So when there's a risk appetite, so when folks are fearful of the state of the world, they buy US dollars, safe haven. risk, we call that kind of a risk on trade, risk off trade. What we've seen, given the amelioration in the outlook, has been a reversal of that, right? So movements out of the US dollar back into other currencies because investors are more comfortable. So that's been a very important driver. So that's, in our mind, that's a good news thing. The state of the world is better. Everybody's more confident, less worry. So you move into other currencies like ours. It's a fundamental driver. And then you layer in on top of that uniquely Canadian things, such as commodity prices. Right? Usually when commodity prices go up, the Canadian dollar appreciates. Right? It's good for us. And you put all that stuff together, and actually what you notice is that by and large, the Canadian dollar hasn't appreciated as much as other currencies have against the US dollar. Right, so we're laggards in some sense. Not a huge laggard, but we're laggards. So it doesn't suggest that we've overdone anything. So we think of the Canadian dollar still being quite supportive of the growth outlook. So again, another factor that we would usually associate with strong growth going forward. And of course, we have to talk about households. At the end of the day, households are, and this is true in Canada, it's true in the US, it's true in other countries, are the main economic driving force. Right? So if households are in a good position, they want to spend, the economy is usually in a good spot. And so let's kind of peel that back a little bit. What we've seen on the household side has been nothing short of amazing over the last year. And I'll start with just the bottom right chart to give you a perspective. So the bottom right chart's got disposable income and the unemployment rate. So usually when you have an economic shock, when folks are laid off, income falls. Normal, right? They go from being employed to unemployed. Usually unemployment benefits are lower than what folks were earning through their workplace. So you get a decline in income. We didn't see that at all last year. The reality was that the generosity of the income support programs put out by the government, both for firms and households, was such that even though we saw this spectacular rise in unemployment rates, which you see in that chart, we saw an equally, if not more spectacular rise in income, disposable income, right? Government transfers were going straight into people's bank accounts, dramatically increasing their savings. And we see that in the top left chart. So these are savings in the Canadian banking system for both households and corporations. And it's the year-over-year increase, so it's in dollar terms. The most recent observation is November. That's as far as we have data for. For households, deposits are up something like 140 billion in November of this year, 2020, relative to November 2019. That money is not going to stay in bank accounts. We know that. There's a question of what it's used for. Is it going to be used to pay down debt? Is it going to be used to buy a house? Is it going to be used to buy a car? Is it going to be used to buy something else? It's going to eventually leave bank accounts. There's a question of when that happens, but it's eventually going to happen. And that, some folks will refer to this as kind of preloaded stimulus. It's basically money that the government gave to individuals last year and continues to give in some cases that is just waiting to be spent. It's it's extremely unusual, as you can see from the chart. And again, speaks to this idea that we are in a position where there are these fundamental drivers of growth that are just sitting there kind of waiting to kick into gear. Same thing, incidentally, on the corporate side. And you can see from the chart, corporate deposits are up about $200 billion year over year. Now, corporations are a little bit more cautious than households, so it's not clear if that's going to translate into investment, but that money is going to go probably outside of the banking system or outside of the deposit base at some point. So you've got households that are sitting a lot of money, but households are also sitting on a lot of wealth. So we talked about the equity dimension of it. If we go to the chart on the right, top right, so this is something that's very unusual. This is the household debt to asset ratio, which is at its historical low now. Doesn't happen in an economic shock. You can think of this as a measure of the strength of household balance sheets, and in a way, they have never been stronger. Right? That reflects the fact that obviously some cash in bank accounts, equity markets are strong, and housing market has been on fire. And you can see that from the bottom left chart, which is owner's equity as a proportion of real estate. So you've heard of folks, taking on mortgages, house prices rising and all this kind of stuff. And the reality is that house prices have been rising more rapidly, sort of the housing wealth part of it has been rising more rapidly than liabilities associated with that. So you've had an actual increase in homeowners' equity over the last few quarters, which again, from a historical perspective, is not what usually happens when there's an economic slowdown. And we know for housing wealth in particular, that consumers spend out of that. In fact, the estimates are, and these are estimates from the Bank of Canada, the estimates are that for every dollar of increase in household wealth, about 5 or 6 cents of that is spent as consumption or something like that. So again, another engine of potential growth for this year. Now, I've given you a very rosy picture of a number of drivers, but the reality is, as you well know, we're still dealing with the virus. There still is, there's still very much a two-track recovery. There are parts of our economy that remain extremely challenged by circumstances, right? All the lockdown parts of the economy, basically almost anything associated with foreign travel, airlines, restaurant accommodations, arts, entertainment, those are all mightily struggling. And you can see that from the chart on the top right here, the K-shaped recovery, which you might have heard about. And all this does is it groups industries by, those industries that are most affected by containment measures versus everybody else. And you can see that for those industries that are most affected by containment measures, they started rebounding obviously after the first phase, but basically since the virus came back in the fall and we started implementing measures, kind of ratcheting measures up, you saw that employment start to decline again. And of course, January saw a particularly big decline in employment. Whereas for other industries, which is a large, obviously a much bigger part of our economy, you've had a completely different dynamic. Employment levels are basically back to where they were. I mean, they're a percentage point or two off, but a very strong recovery. And the same thing is true, for instance, if you look at full-time versus part-time employment. Full-time employment's been very strong. Part-time employment, obviously, in concentrated industries that have been affected by containment measures, much lower. If we go back, obviously, to the unemployment rate, which is obviously, as I indicated, jumped quite significantly earlier, I guess, last year, it remains reasonably high, right? It's going to take a long time to work off what the shock that we've gone through. So even though we anticipate pretty strong growth this year, it doesn't mean that labor market conditions in general return back to where they were. The unemployment rate is probably going to take at least 2 years to go back to where it was pre-crisis. So ongoing kind of labor market challenges for certainly a number of Canadian workers. From a regional perspective or from a city perspective, the trends are reasonably similar. From a provincial perspective, everybody's kind of come back more or less at the same pace. BC has done a little bit better recently than the other provinces, but not really a whole lot of difference to speak of. From a city perspective, it's a little bit different. And there are some interesting things, like Calgary being the city whose employment has recovered the most, versus, say, Montreal, Toronto, Vancouver. Montreal has generally done quite well up until a few months ago, and that's obviously related to the pandemic. So a little bit more differentiation on the city side, but generally speaking, everybody's kind of got the same trend. So outputs or labor market generally improving, even though unemployment rates are going to be elevated for quite a period of time. Now, speaking of, maybe drilling down the housing market a little bit, because it's so important to understand what's going on. So as I indicated, there is a big housing wealth effect that is taking place, and that's going to take place. We're richer because of our housing wealth, and that's just, it's a fundamental economic reality that leads to strong growth in Canada. There's no question about it. So there's a question about how sustainable the housing market is. And if you don't think it's sustainable, you're not going to spend. And if the market reverses itself, then you get a decline in wealth, and that works the opposite way. So that's a huge question for the Canadian economy. Actually, we think it's a question that's going to be, once COVID is behind us, we're going to keep talking about housing for the next little while, because affordability, in our view, is not going to change. You can see, so this doesn't include the data that we released this morning, the housing data we released this morning, home sales data we released this morning. This is using the December data. But home sales through the pandemic are basically record levels, which is, again, kind of surprising. A big jump in the unemployment rate, usually not an environment where housing sales do well. December housing sales are highest levels in history. January, which was published this morning, again, highest level in history. An extremely strong housing market. And it's a housing market that was characterized pre-pandemic in much the same dimension as it is now. That is to say, population growth, so demand for housing, has far outstripped the supply of housing, right? So if you want to think of it very simply, the number of people, which is what the chart on the bottom here points to, the number of new people in Canada over a certain period of time, so 18 months, relative to the number of new housing units that were built. Ideally, you'd want, something pretty stable. What we've observed over the last number of years is population growth has been so strong because of immigration that even though construction activity is really strong, simply hadn't kept up. So chronic undersupply of housing in the country, and this is broad-based. It's not just a Toronto, Vancouver story. It's generally broad-based, and that means that the housing dynamics said that we saw going into the pandemic, which was demand was stronger than supply, in some sense amplified through the crisis as we turbo boosted demand through lower interest rates. And obviously construction was affected for a little while, even though there's a big slowdown in population growth because the borders are closed. So as we put that all together, we think that that supply-demand imbalance isn't going to change anytime soon. It's going to take a huge amount of construction for that to happen, and it's like a 2-3 years worth of construction with relatively flat population growth, which obviously is not a very reasonable thing to say. So as a result, when you look at the chart on the top right, so this is what we call the sales to listing ratio, and compare that to house prices. Historically, there's a very tight correlation between the sales to listing ratio, which is that black dotted line, and house prices with a lag of about 6 months. And that sales to listing ratio at the national level suggests that house prices are still going to go up quite a bit. Now, that's not necessarily a forecast. There is a point where the market is going to have to slow a little bit because what we're seeing in terms of activity is unsustainable. And one way to think about how unsustainable that is basically to look at the months of inventory of supply. So how many months of months of sales. How can I say this? How many months of sales are covered by listings? And for the country as a whole, that ratio is the lowest level it's ever been. Basically 2 months. For certain cities, it's a lot less than that. Montreal, I think, is less than 1 month. Montreal is about 2 months. Toronto is less than 1 month. But almost anywhere you go in the major cities, you're looking at historically low levels of homes for sale relative to sales of homes. And that, that's going to cause a few little things, obviously. I mean, January lockdown, so you obviously naturally had a bit of a pullback in listings. We think that's going to improve as the spring season comes along. But what is also likely to happen is we're going to see folks increasingly turn to renovating their places as opposed to buying a place, just because there's nothing available for people to buy. So it means higher prices for homes. It means more construction activity and that kind of stuff, stronger lumber prices and various things. And that's even though we've seen folks move out of major cities and go into smaller cities as a result of the pandemic and working from home. This transition, it's even as a result of rents coming down on condos in a lot of the cities as students were going back to school, particularly international students were going back to school. Airbnbs couldn't be rented because nobody was allowed in. So you saw a movement down in rents. We didn't see a kind of a commensurate movement down in condo prices because demand was generally pretty strong. So keep that in mind, because that, again, this is an important thing. Housing wealth in Canada is a huge driver of growth. We can't get away from that. It's not, it's not a public policy thing. Are we investing too much or too little in housing? It's simply that we consume out of housing wealth, period. And let me just wrap up with this before we can maybe go through a bit of a question and answer period. You know, as I said, housing has been partly determined by the strength of population growth. And you can see from both these charts how strong that's been in the 2016, 17, 18, 19 period. 2020, obviously, completely different dynamic because that population growth was essentially, actually wasn't essentially, was driven by immigration. You shut immigration down, obviously you get a different population growth dynamic. We know the federal government is aggressively trying to make up for that. So they have immigration targets next 3 years, which are pretty aggressive, which should mean the population growth stabilizes at, you know, around 1.1%, which is by historical standards still pretty strong, not as rapid as what we saw earlier in the last couple of years. But that's because we were, as you can see from the chart on the right, on the immigration side, just ramping up immigration extremely rapidly. But all that to say that you know, immigration is going to rise, population growth will resume, and of course, from a distributional perspective, we know that immigrants tend to go into major cities, and that's Toronto, Vancouver, Montreal. There's a little bit of a spreading out now, but essentially that's where the pressure is going to be as we ramp this up. And that's another factor that suggests to us that as you know, immigrants come back into the country, we get another push on the growth side. We've often in the past talked about immigration in Canada as human stimulus, and that will occur in the second part of this year. So let me wrap it up with coming back to where we were before and talking about a little bit some risk. So this is a copy of the first slide that I presented. Hopefully you understand a little bit why we are reasonably optimistic for the US and for Canada and for the world in 2021 and 2022. It looks like all the drivers are there for a really strong recovery. It looks like the risks are tilted to the upside when we don't pay attention to COVID. Now that's a big assumption, right? We're dealing with now. You know, there's concerns about the rate of vaccination rollout in Canada. There's concern about the economic consequences of the lockdown and you know, how long it should last. And of course, that's a huge downside risk. There's no question about it. Is it a risk that's manageable from an economic perspective? Well, probably. I mean, setting aside for a second all the things I've indicated in terms of fundamental drivers of growth, one of the biggest surprises that we've seen in Canada, and actually in a lot of countries, not just Canada, in the fourth quarter of last year and even into the first quarter of this year, or January, is despite the dramatic increase in infection rates, despite the dramatic increase in deaths, hospitalizations, and containment measures, economic activity was incredibly resilient. Right? GDP in Canada probably grew by about 8% in the fourth quarter of last year. In December, Stats Canada estimates that GDP rose by 0.3% on a month-over-month basis. In December, if you'll recall, is when a lot of provinces like locked it down, right? Made it very, very difficult to buy stuff. Still, the momentum is so strong that you're managing to generate growth out of that. And in fact, when we think about the first quarter of this year, so you know, the little dip there, Q1 2021 F, it looks like the first quarter is going to be positive, even though there were curfews in Quebec in January, severe lockdowns in a lot of the provinces. The underlying momentum is just kind of powering us through that. So it's not inconceivable that even in a scenario where it takes longer for the vaccine to roll out, or there's a mutation of the virus and you know, infection rates pick back up and there's another wave in March or April, that the economic consequences of that wave aren't nearly as negative as we fear they might be, given that we now have the experience of having to live through the second phase and seeing how the economy's responded to it. So I'll leave it at that. So even on the downside, which are substantial, it's not clear that those downside risks, if they happen, would translate into a vastly different economic outlook. It's possible that we just power through that as we've been powering through for the last number of months. So with that, I'll open it up for questions if there are any, and I will stop sharing this presentation for the time being.
Thank you so much, Jean-François. Really, thank you for sharing your insights with us. Really appreciate you taking the time. It's giving me a lot of reassurance, and we are seeing, increased momentum and activity also on the banking side. So it lines up with your comments. I'll ask Lorraine. I do see questions in the chat already. There's a couple of them. So Lorraine, do you want to perhaps take that over? Would you like me to do it?
I can do it, Maria. Oh,
all right.
Yes, so let's start with the first question from Stephen Wise. How could government stimulus to individuals be redirected to middle-income households in need for immediate spending versus add to savings?
Yeah, so that's a good question. So there's a few things that happened. The CERB payments obviously were targeted to individuals that were affected by COVID. Those were overwhelmingly, not exclusively, but overwhelmingly individuals at the lower end of the distribution of income. And we actually see that. So if we look at, for instance, the deposit data within our own bank, the percentage increase in deposits in households is stronger the less income they have. Obviously, in terms of numbers, it's low. It's lower because wealthy people tend to accumulate savings, good times or bad times. But there's clear evidence that even in the middle to lower income streams of income, deposits have been rising. So they too have money to spend, if you will. But perhaps even more importantly on that question, and it's one of the reasons we think, say, the fourth quarter was better than we thought, or the first quarter might be better than we thought given the lockdowns, is for a large number of affected workers, part-timers and the restaurant, food accommodation, travel, business, the generosity of the EI system, or the temporary generosity of the EI system, is such that for a lot of those workers, they actually earn more still by not working relative to working. So in a sense, their financial situation, I mean, it's kind of crazy to say that, but their financial situation has been a little bit better over the last number of quarters than otherwise would have been, by virtue of the fact that, they're getting basically a little bit more than minimum wage from the government, and they were earning minimum wage before. So it's a bit of a nuanced picture, but generally speaking, there's been quite a bit of improvement, even in those that are renters or part-time workers, relative to what we would have thought, and certainly relative to this time last year.
Thanks. So let's take another question from Jonathan Brindley. There has been a lot of talk about the K-shaped recovery with the growing gap between the haves and have-not. Will this have a drag on the economy and the recovery?
So the K-shaped recovery, so I had the little chart that talked a little bit about it, but if you think about the next 12 months, the industries that have struggled the most are likely to be the ones that do the best when we reopen completely, right? So we know that there is huge pent-up demand for all kinds of things, right? There are shortages of cars, you can't buy a boat, like there's the really big ticket item stuff. But we know that people are dying to go out. We know they're dying to travel, right? Like I read a statistic a couple of weeks ago, like I think it's like 90 or 95% of all Ontario cottages are already just rented for the summer, which is like something that apparently never happens. It tends to happen like in May or June or something. Same with things like, Carnival Cruise Lines. So Carnival Cruise Lines, their 2022 sales are already stronger than the 2019 sales, right? And that speaks to, this desire that people have to resume activities that they can't really do, that they haven't been able to do now. Certainly in Canadian context, Americans are a little bit different because they seem to be able to do a whole bunch of stuff without really caring about the virus, but we're talking about Canada. So as we progress with the virus, and it's increasingly a rearview mirror, and we increasingly make it easy or allow people to, travel and go out and have fun, those are the parts of the economy that we think are just going to roar back in the second part of the year. So, K-shape for now, but, we expect that kind of downward part of the K to kink up pretty aggressively in the second part of the year, and beyond that, as we just go back to a version of life as we used to know it.
Thank you. So next question is from Raoul Heredia. Mr. Perrault, the following are your comments to Mrs. Freeland at the recent Economy Summit. Effectively, what you've done over the last year is subsidize labor at the expense of capital. So of course, firms haven't been investing, he said. At some point, that created an issue in terms of sustainability of growth. Can you please shed more light on your proposal to subsidize capital investment?
Yeah, so it's very simple. The reality is that firms, when they, as all of you know, when they decide on a capital spending plan, think about the economy, think about rates of return, consider how confident they are in the state of their business or the state of the economy and a range of things. So the idea that firms would invest in a period of high uncertainty, because there still is. I mean, as much as we like to think the growth is going to be very strong, and we're pretty confident, I mean, the reality is it's going to take a few months to get there, a few weeks, we'll see, and that could be wrong. I mean, maybe the virus mutates and the vaccines don't work anymore, and we're in this really bad state of the world. So the idea was, given the fact that the budget's not really a constraint anymore for the federal government, and they can do whatever and spend billions and billions of dollars, nobody seems to care, why don't they come up with a policy that basically encourages firms to invest in capital spending very aggressively to build it back better as soon as we can? So our idea was pretty simple, was basically to say, for the federal government to create this kind of matching grant, which is basically would say, if you are a firm and you are undertaking investments in machinery, equipment, or intellectual property, we're going to give you $25 for every $100 that you spend, or something like that. And that's only going to be in place for the next 12 or 18 months, right? Because you want firms to really take advantage of that. So that's the idea, is just a way to get the government to help firms turbocharge investment, so that we take advantage of low interest rates, we take advantage of spare capacity, we take advantage of the need to retool in a lot of industries, and you just put that in gear and try to help firms in as direct a way as possible, much like we did for firms with labor and the wage subsidy, which was designed to basically help firms say, keep these workers on, you may not need them, but keep them on, and we're going to pay 3/4 of their salary up to a certain amount.
Thank you. So next question is from Tony Galota. Do you believe the stock market is representative of current economic, or is it ahead of itself in anticipation of a hand to lockdown, or is it just a big bubble?
Yeah, I don't really think it's a bubble. I don't. So for instance, if you think of our US forecast, so we're a little bit more aggressive than others on the US forecast at 5.8, consensus is probably 5.5 or something like that. The reality is that if we're right and those risks are tilted to the upside, which it very much appears that they are, then if that materializes, then you're talking about higher profits and a higher level of achievable stock markets. So part of what we're seeing, I think, in markets is a gradual recognition that, yeah, the U.S. economy has got more legs than we'd anticipated, and obviously that means a better environment for markets. Combined with, and this is important, combined with interest rates that remain at historical lows. All right, so that combination, very, very strong growth, extremely low interest rates, that suggests to us that what we're seeing in equity markets is probably sustainable, and maybe, and I've been saying this for a couple months now, and there's probably still more upside to that. Maybe not a huge amount of upside, but certainly a little bit more upside, given the fact that data keep surprising to the upside, economic data.
Okay, next question from Annie Moalen. So he would like to have your opinion on where you stand regarding the retail industry overall, mainly for retailers that have a B2C model with a low percentage of their sales done online and most of it through physical premises.
So it's a tough, I mean, it's a tough question, but it's a tough question because it's clear that, I think it's clear that we have a little bit less understanding of how consumers want to engage with companies on the consumption side than we thought pre-crisis. And I say that because, you know, it looks right now that consumers are trying to buy anything they possibly get their hands on, whether that's in a store or not. You know, and that's true. It's true in large parts of retail. Obviously, it's true in kind of the home building stores and all this kind of stuff. And I say that because you know, one of the questions we have in our mind is as we allow folks to, I mean, think of, I don't know if you did this over the holidays, but over the holidays, you know, malls in shopping centers in Ontario were open still. And, you know, I've got 4 kids, so they wanted to go to the shopping center to buy stuff for Christmas. And like the shopping centers were packed. And which was, you know, not what we thought was going to be the case, you know. People could do their online shopping, and they did, worried about the virus, but that wasn't, you know, there was something about the shopping center that drew people there, whether it was a food court or whatever it was. And that to me was a bit of a light bulb moment, which is, you know, that there's more interest in doing kind of face-to-face shopping than I would have thought. And whether that's just a social phenomenon, whether that's just, you know, some goods like clothing are just easier to buy when you're in a store than they are buying online. I do think there is likely to be a little bit more momentum in the physical retailing part of the industry than we would have thought maybe a few months ago. Certainly would have thought pre-pandemic. But maybe that's an overly optimistic take. I don't know.
Thank you. Next question from Elliot Venesi. Would you expect federal authorities to take new measures to keep housing prices under control? Given the decrease in interest rates, the stress test measures have been partially, if not totally, offset.
Well, so this is so one of the reasons I said we're going to be talking about housing for much of the year, I think, and we're going to write a lot more about it, is there is going to be pressure on governments to do something. The problem with the pressure on governments to do something is, unless you're doing something about supply, you're not really fixing the problem, right? So you can you know, make it harder for foreigners to buy places, even though it's like a fraction of the market. You can put, you know, more demanding stress tests. You can do a whole bunch of things that, you know, bring demand. Well, there's 2 sets of demand measures you can do. One is to make it harder for people to buy a place, right? So stress tests and those kinds of things. The other is for make it easier for people to buy a place, like, you know, expand the first-time home buyers credit, or make it easier still to buy, you know, to borrow your down payment or pull more money out of your RSP to buy your first place. Those types of measures only add to demand, as opposed to the other measures which subtract from demand. But those are, you know, they're tinkering around the edges, because the reality is, you know, when you think about it from a really, really big picture perspective, the problem is there aren't enough homes in Canada for the amount of people in the country, right? So it's not a speculative thing. It's not, you know, should we prevent more people from coming in? It's right now, we don't have enough homes. So, you know, tinkering with things, and I suspect they're going to try and do stuff, but that, you know, that ultimately isn't going to, I don't think is really going to solve the problem, because if those types of measures were likely to solve the problem, we would have solved it last year, the year before that, a year before that. And that's just not happening, because there aren't enough homes for the number of people in the country.
Thank you. So another question. Canada has spent more per capita than any other OECD country on the recovery from the virus, but with really not great result on unemployment and prospective growth. Why is this?
So here's that's an interesting question. I feel like I'm saying that a lot, actually, but so it's true. I mean, Canada last year spent a crazy amount of money, right? So the deficit will probably be about $400 billion at the federal level. It's by very far the largest ever. Other countries spend a lot of money as well. But as you probably recall from my first chart, GDP in Canada fell by about 4.5% last year, whereas it fell by only 3.5% in the US. So the Americans did something differently. They spent less than we did, but they got better outcomes. When you look at GDP, obviously they had much worse health outcomes, so way more people died, and that was the trade-off. But if you think of it in labor market dimensions, this is where it gets really interesting. The employment recovery in Canada has been stronger than the employment recovery in the US, right? So we lost more people, we hired more people back. And of course, part of that is probably because the government was giving wage subsidies to firms to hire people back. So on the employment side, it was, it's a different story that, we managed to keep more workers through the pandemic than the Americans did, even though we had a worse economic outcome. And of course, there are other reasons for that as well. I mean, we're a big energy exporter. Oil prices crashed in the first part of last year. If you remember, oil prices for a few days were actually negative. So, those things are important in terms of understanding why things were worse here. But that dichotomy is going to flip, right? The Americans this year are going to spend belatedly way more than we are, right? And like many times more than we are adjusted for GDP, and that's likely to continue going forward. So we were, if you want, more forward-looking in terms of how we provided support. It led to whatever it did. The Americans acted pretty aggressively last year as well, but they're acting equally, if not more aggressively, probably for the next couple of years, as a bit of a delayed reaction. So it's not clear how, when you put all this stuff together in 3-4 years from now, who will have had the best policy response. But just from the employment dimension, we so far are doing better than the Americans in terms of that recovery.
Thank you. So we're going to take 2 more questions. First question from Clarence Ribeiro. How do gold prices overlay with your charts?
So gold has generally been doing pretty well up until a couple months ago, I think. I mean, gold is inversely related to the price of treasuries, which of course yields have gone down, gold has gone up. That's started to change over the last few weeks. Gold is historically a an inflation hedge. So when inflation expectations go up, usually it's reflected in interest rates, and that makes the price of gold move. But I would say that over the last little while, what's kind of complicated things on the gold front is, this move into cryptocurrencies, with Bitcoin to 50,000 and other stupid things going on. You've got investors that are looking to diversify the types of instruments that they historically have used to protect themselves against inflation or, currency depreciations or various things. Historically, that was gold. But there's a much greater opportunity out there to diversify now. So our sense is that there's a bit of a structural kind of component to the gold market, which is, there'll be less of the kind of the financial demand for gold going forward than we're used to experience historically. So that's likely to change the relationship between gold and economic variables and sentiment relative to the past. So, and probably not for the better.
Thank you. And the last question is from Bram. We only hear doom and gloom from Alberta, but you said Calgary has had the fastest recovery. Please explain what is reality happening in Alberta.
So there's a bit of a mystery there. Alberta was the worst affected province last year, right? The decline in GDP of about 7%, and that followed, declines in GDP for the last 2 or 3 years before that. Alberta's really been struggling for the last number of years because of oil prices, essentially. So, it is a little bit of a surprise to see Calgary employment rebound, but what's often failed, what is often underappreciated, particularly in Calgary, is the vibrancy of the tech sector. And that's been, you've seen actually pretty significant investments and deployments of capital to the tech sector in Calgary, even through the pandemic. So that's helped offset, that's helped kind of create particular conditions in Calgary. The housing market's been pretty strong there as well, in part because of that. in part also because there's been a move out of, you know, as said, as part of this working from home phenomenon, people being a little bit more detached from head offices, a move into Calgary from places like Vancouver and Toronto, just as there's been a move into New Brunswick from places like Toronto and Montreal. So that's helped to benefit the Calgary economy in a bit of a unique way relative to the rest of the province. But it's you know, it has been a challenging year. And of course, if the increase in oil prices that we've seen continues, and evidence suggests that's going to be the case, you know, we are looking at a fundamentally more positive oil price outlook for the country, and obviously that's concentrated in Alberta, Saskatchewan, and Newfoundland. So we do think that, I mean, we are getting ready to raise our forecast for Alberta if oil prices stay at current levels, because they are currently significantly above where we thought they would be. So there's upside from an Alberta perspective as far as we're concerned, and maybe what you're seeing in Calgary is a little bit of front running of that.
Thank you, Jean-François. Thank you, Maria, for arranging this. This has been hugely informative and important for everyone to hear. It's great to have an optimistic message. We try very hard at the M&A Club to bring optimistic, if I could say, presentations to our members. We hear enough on the news about the other side. So it's great to hear. Thank you very, very much again. To everyone, Jean-François's PowerPoint will be available, will be sent to you with the list of attendees and their contact info, as we always do. This session has been recorded, and in the future, we're not quite sure how we're going to do that. It will be available to members. So stay tuned. There are lots more interesting presentations coming. One of the ones that may be sort of the other side of the coin, Jean-François, we have Daryl Bricker, who's the head of Ipsos, going to be in conversation about what's, I would say, sort of what's really going on with demographics and migration and other issues in the economy, and looking forward. And that's going to really be interesting, especially referenced by what you were saying this morning. So stay tuned for that, everybody. That's coming up, and that should also be fascinating. Thank you very much. The upcoming webinars will be sent to everyone through our mailings, and we hope to see everyone soon. Take good care, stay healthy, stay creative, be well, and au revoir. All the best to everybody.
Thank you, Bram.
Bye-bye.
Thank you, Jean-François. Bye-bye.
Merci.
Thank you.
Bye.
Bye.